Okay, everybody. Conan and I are both on vacation this week, and we're not in the podcast studio. So, what I'm going to do is record what I was going to do this weekend if we were together in the podcast studio. It's going to be the same content. I know it's a little bit different. Hopefully, you guys can get past that and appreciate the content. All right, so here we go. TSP Weekly Podcast, 28 April 2024. So, a bunch of interesting questions this week in the Facebook group. I'm going to put up one of the questions and a bunch of the comments from it. But what I really want to focus on is this distinction between market timing and risk management. The purpose of the Facebook group, the podcast, the newsletters that we put out, the alert analysis, it's all for education and analysis. Okay, we all have different circumstances and risk tolerance. We look at different timelines of investing, and you cannot day trade the TSP. So with all that in mind, we're going to look at market timing and risk management. What do I do now, right? It's been a very volatile couple of weeks, so what do I do now? Zooming in and out in terms of time frame can really help when we look at support and resistance levels. And then where do we go from here, right? Where can the market go? The bonus chart is going to be Meta, because as I'm recording this, it is Thursday morning and Meta is really bringing the market down. And then we'll take a look at the C Fund Weekly. And again, this is through some of these you're going to see the pre-market open price. So I'm doing this actually on Thursday morning. Okay. So here was one comment we got this week on Facebook. Had a whole lot of people commenting on this post. So here was the post. If you moved to the G Fund on April 5th and did not move back on April 18th, you missed huge gains on April 22nd and 23rd. It's all about timing. So if you are a subscriber to Grow My TSP, we put out alerts when we make a reallocation within the Grow Model portfolio. So we created this Grow Model portfolio as a guide for people to use to help manage to help make their reallocation decisions. So you could follow along with our alerts and when we make a change in the portfolio, but that's really not the point. The point is to use it as a guide and apply your own personal circumstances and risk tolerance to the portfolio. It's just a guide to help you guys kind of have left and right limits. That's all it is. So if you were following the portfolio, we reallocated to the G Fund on April 5th. The market subsequently went down about 6% as of last Friday's close from that point. And then we had a bounce on April 22nd and 23rd, right? So our response to this post was, I'm not sure exactly how to reply to this post. If you reallocated to the G Fund on April 5th, you avoided about a 6% drawdown to Friday's low. Then that was in the S&P 500. Monday and Tuesday, right, of this week recovered less than 3% of that drawdown. So Monday and Tuesday was the 22nd and 23rd. So if you're down 6% and you recover, half of that, I don't see how you're missing big moves. You didn't take a loss is what happened. You didn't miss a big move. So I didn't know how to respond to that post exactly. And then another comment, so did you tell people to move back on April 18th for close of business April 19th? That would have been good advice. We don't know that would have been good advice yet. And we're going to get to that in a couple of charts. But again, this is not day trading. And we are not telling people what to do with their money. We created this portfolio as a guide for you guys, okay? That's the way to go. Timing the market is no better than a gamble, but the market always goes up if you can hold on long enough. Well, we all know the market does not always, well, yes, does the market always go up if you can hold on long enough? Sure. I don't know that anybody that wanted to take the 25% drawdown in 2022, the 35% drawdown from COVID, there's plenty of examples. Sure, if you hold on long enough, If you're early in your career, does the market always go up? Yes, we talk about that all the time. The market goes up and down in cycles. Regardless of what the market's doing, if your risk tolerance allows, stay the course and don't try to time the market. Just keep it in the fund of your choice. Again, you can do that. There's nothing wrong with the buy and hold methodology. You can do that as long as you can stomach, like this person says, if your risk tolerance allows, if you can stomach the significant drawdowns that we periodically get. This was kind of one of the funniest ones, I thought. Moving to the G fund is always a stupid idea. I don't know. I don't even know what to say about that. If you think the G fund, I would say that moving to the G fund is a bad idea for the past 40 years because we have been in a declining interest rate environment. And so the G fund is based on the interest rate. So as the rate of interest comes down, the gains you're getting in the G fund come down. That bottomed out back in 2020. And so as interest rates have gone up, your rate of return in the G fund goes up along with interest rates. So that's why there's a lot of talk about bonds in the market now. You're getting a better rate of return in bonds yield than you used to, right? So the G fund, the value of the G fund is increasing as interest rates go up. And the G fund cannot have a negative quarter by law. So you cannot lose money in the G fund. Okay, you can't time the market, or people would have figured it out by now. This idea of timing the market, I'm going to get to, I think, on the first slide, but we're not trying to time the market. We're trying to observe when the trend in the market changes. When the trend changes, if it changes to the downside, you don't want to be in the stock funds. When it changes to the upside, you do want to be in the stock funds. We're not trying to time the market. That would be using a crystal ball. We're observing the market and seeing when the trend changes. Okay, but when do you put it back in? This is the hard part. You haven't done any good till you time it right back in. It's the same methodology. When the trend changes from moving higher to down, you reallocate to the G fund. When the trend changes back the other way, from moving down to moving back up, you reallocate into the stock funds. If you have long, slow trends, it's relatively easy to see those trend changes. When you have the market going sideways, it can be very difficult. But at the end of the day, what we're trying to do is manage downside risk. So market timing versus risk management. This is a chart that we put up in the alert analysis back on April 5th. So it was actually April 4th, but this is the closing price on April 4th. So you got the next day's closing price. If you would have done your reallocation on the morning of April 5th, and so you would have gotten that day's closing price. But the alert analysis actually came out on April 4th. So this is a daily chart of the S&P 500 RC fund, and what precipitated the alert analysis, like I said, we're trying to manage risk. Okay, every time. So the C fund broke out of last summer's downtrend. Okay, here was last summer's downtrend. The C fund broke out of it right here when it got back above the 20-day moving average line. Every time price dipped down, right, it doesn't go up in a straight line. It has these oscillations, right? The 20-day moving average line in blue provided support for price every time it came down to that line, all the way along, right? From this breakout last November until April 4th of this year. Okay, that's when things changed. We're looking at 1, 2, 3, and even April 4th came up and tagged that resistance level right here at, I don't know where this was, 5,200 or so. So this was a resistance level the price couldn't get above for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, right? And then the 10th day it broke down, engulfed all the price from the previous 3 days and finished below that 20-day moving average line. Okay? So the alert that came out, the reason we reallocated back to the G fund was because something had changed in the market and we wanted to manage risk. And so the risk in this case is two things. Risk is there are two prongs to risk. There's opportunity cost risk and there's potential loss risk. So in this case, we got out of the stock funds the next day's closing price, which actually the next day was up. So we got out of the stock funds basically there. That means our potential loss, right? This was the resistance level. This is where we got out. This little difference is what we would have not, if the market turned and started moving higher and we got back in here when it got above that line, we would not have got these gains. Okay? So I'm not sure, say that's 1%. I don't know how much it is. Say the distance between, where we got out right there and if the market had gotten back above this high, say this distance here is 1%. Okay? We would not have gotten that 1% gain. We would have gotten back in if it got above that line, right? So we would have continued with the rally, but we would not have gotten that 1% gain. So that our risk was not getting 1% to the upside. In exchange for that, we stopped all potential losses of the market going down. Okay? So, and we made, very minimal gains in the G fund. But the whole point here is to manage risk. We saw a change in the market right here, right? It had been well-established support since the breakout back in November. We saw a change on April 4th, and we managed risk around that. That is not market timing. It's risk management. I have no idea whether or not the market is going to continue higher from here, go sideways, or go down. All we were doing in that case was managing downside risk. Okay? And then what happened? This was April 4th. This green day is the day we actually got out, and then the market went lower. Okay? Yes, it got back up above that 20-day moving average line, but never got back up to that overhead resistance, and then finally broke down below that 20-day moving average line and kept on going. Okay? We had a little recovery, like that person's comment was, we had a little recovery on Monday, Tuesday, but then we hit resistance again at that 20-day moving average line on Wednesday. We also couldn't get above 50 RSI. CCI is not above 0. MACD did not cross positive. We don't have buyers, the green ADX line, coming into the market above that 20 level. So we had no reason to get back into the stock funds because we don't have a confirmed trend change back in the other direction. Okay? And we know that the 20-day moving average line, while it acted as support all the way back here, it's now acting as resistance here. So until price gets back above that 20-day moving average line, the short-term trend is down. Okay, we have no way of knowing whether it's going to get back above that line and keep going, or if it's going to hit resistance here, get below this low and keep going down, right? There's no way to know that. We are managing risk. And right now, the short-term trend is down. Okay? All right. So what do I do now? Okay, we get this question all the time. If you go to growmytsp.com and go to the blog tab, right, or just type in growmytsp.com/blog, this is a video, a blog that we did quite a while ago. What should I do now? It depends. It's a really good blog post. Definitely check it out if you want some ideas about, what should you do now? The market's been going down for the past couple of weeks. If you're still in the stock funds, it's a difficult place to be because if you were to get out of the, if last Friday, which was right here, the market was about 6% down from the high, your risk now is 6%, right? Because you would have, if you get out here, you would not get those 6% gains, and then the market keeps going higher, right? And then you have to make the emotional decision to actually get back in here. So the further down you get from the top, the more difficult the decision process is and the higher the risk is. That's why it's really important to catch the trend changes as early as possible, right? And that's what we try to do. Okay, so what do I do now? As of Wednesday's close, right, we are hitting resistance at that 20-day moving average line. So there's two possibilities, right? Either the market breaks through that 20-day moving average line and keeps moving higher, okay? Or it hits resistance at that 20-day moving average line, moves lower. If it gets below this low, it probably keeps going lower, okay? The third possibility is that it comes down, does some kind of double bottom, and moves sideways. So you have up, down, or sideways. That's basically it, okay? Okay. So zooming in and zooming out can be really helpful. So if you're kind of lost on a daily basis, like what should I do? If you zoom into an hourly chart, okay? Hourly charts aren't very useful in TSP because we only get 2 moves a month. You have to have your move in by noon to get that day's closing price, but it can help to identify when things are potentially changing in the market. So this is an hourly chart of the S&P 500, right? We're going back to about the middle of February. The biggest takeaway here is, we're at a low, the market comes up, comes down, puts in a higher low, okay? Goes up, puts in a higher high. So when you have higher highs and higher lows, the trend is up, okay? Market keeps going up, corrects a little bit, puts in a higher low, comes up, puts in a higher high, okay? That's how it works. It oscillates back and forth, and as long as you keep having higher highs and higher lows, the market's continuing to go higher, okay? And we get that all the way along. At this point, in somewhere around the 20th or so of March, we put in a high. We have a higher low, okay, but the next high does not go higher, right? That's the first indication that maybe there's a red flag. Again, this is an hourly chart, okay? It's not daily, it's hourly. Now we do not have higher highs, and here we have a lower low, right? So now we really have a big flag, red flag. The next rally, again, let's call that even. So we have a triple top, okay? Then we have a big move down. So now we have, arguably lower highs and lower lows, okay? We haven't seen that all the way back through here. That means the trend is changing. That's all you know. You don't know if it's going to, turn back around and head back up. That's possible. But the trend has changed. And so that's giving you, the trend changed on an hourly basis, okay? So it's telling you that something is happening underneath the market, and it's time to start looking at managing risk. And so the market comes down and then broke above that 20-hour moving average line on Monday or Tuesday of this week. What's significant here is that it found support at that 20-hour moving average line, right? So from the context of this downtrend, this may be a new uptrend taking place, right? Because we got back above that 20-hour moving average line, came back and retested it and found support there, okay? So that's on an hourly basis. It's not on a daily, but it's saying that on an hourly basis, at least, the trend is starting to move the other way. You would also draw this trend line, and until we got above that trend line, I wouldn't really give this too much credence. But at any rate, that is how you kind of zoom in and zoom out, right? If you're lost on a daily basis and you're not sure, you can zoom into an hourly basis. Okay, so where can the markets go from here? So markets either go up, down, or sideways. Okay, this is we're back to a daily chart of the C fund. Okay, here was the low last October. The blue line is the 20-day moving average line. The green line is the 50-day moving average line. Okay. So the market breaks out above that 20-day moving average line. This was April 4th. So these three highs right here represent a swing high, it's called. And the first move down that we had through last Friday gives us the first swing low. Okay? Because we had a recovery off it for 2 days. So now we have a high point and a low point. Okay? So if the market either goes up, down, or sideways, what's going to happen is either the market goes up, breaks through this resistance level, and keeps going, right? That's one option. The other option is the market, it closed below that 20-day moving average line on Wednesday. If price rolls over and we get below the swing low, then price is going down. Okay? If price comes down, gets support here, comes back up, it can oscillate sideways. So sideways is the third possibility. Okay? And we don't know. We're not trying to time the market. We don't know what's going to happen. We don't have a crystal ball. All we knew was back here, right? The trend, what had been happening in the market since the end of last October changed. And we were managing risk. And now we're managing risk going forward. Okay? Okay. All right, so hopefully that gives you guys an idea of the distinction, because it is a giant distinction between managing risk and trying to, quote unquote, time the market. Okay, Meta. Like I said, this is Thursday morning, and Meta had some really, it wasn't that they had bad earnings, it was that Zuckerberg came out on the earnings call and told investors things that they didn't want to hear. And so this is the price at, what time is this? About 10 till 9 in the morning on Thursday, right? So Meta is going to open way down. It's going to gap down. Okay, so price is going to open there more or less at $415, right? $415. And it closed yesterday, or closed Wednesday at $493. So it's a big, big gap down. Okay, there are three gaps, three primary gaps that you kind of want to understand: a runaway gap, an exhaustion gap, and a breakaway gap. Okay, runaway gap. Let's take this first one, runaway gap. So we had a peak here in Meta, along with the NASDAQ in 2021, right? Because the NASDAQ rolled over before the S&P 500 did. Here was January 2022. So Meta peaked back here in the beginning of the fourth quarter in 2021. Price came down, stabilized a little bit, and then we had this huge gap down. Okay? It's a runaway gap because price had already been declining. We had the first move down, we have a sideways correction, and then investors just got out of the way, and we had a big gap down. When we got close to the bottom, right, here was the bottom in October 2022, we had another gap. It's called an exhaustion gap. It's when finally people just say, I've had enough, I'm getting out, I've lost too much on Meta, I'm getting out, and investors tend to do it at the same time, and you get what's called an exhaustion gap. And that tends to be really close to the bottom. right? And this is a good example of that. We got two more. So we put in the bottom. The market turns back up. So, for several months, the market's moving higher, and then finally investors jump in, just like they do on a runaway gap to the downside. It's the same thing on a runaway gap to the upside. Investors are starting to see that Meta is what they call catching a bid, and they all jump in, and the price gaps up, right? So it consolidates a little bit, continues to move higher, and then some news comes out, and it gaps up again. It's another runaway gap, okay? Then this is arguably an exhaustion gap, right? You could call it a runaway gap, exhaustion gap. It's price did move quite a bit beyond that, so I'd probably characterize that as another runaway gap. But this last one, the one that we're having today, this big gap right here, that's another breakaway gap, right? It's the beginning, because price hasn't already come down a lot in a first leg. This is the beginning of a move down in Meta. It's not the end. It's not an exhaustion gap. It's a breakaway gap. So Meta's in trouble, and it's one of the Magnificent Seven, the Four Horsemen, however many of these companies are left that are still propping the market up. But Meta is going to be a big problem for the market on Thursday. So when you guys are listening to this on Sunday, again, I'm recording it on Thursday morning. But Meta is going to pull the market down for the week. Okay, C-Fund chart. We always look at the weekly chart. Again, this is a weekly chart of the C-Fund. Each one of these rectangles is 1 week of price movement. You got the 20-week moving average line in blue. And this is a Fibonacci tool. So the retracement levels of moves tend to work on Fibonacci numbers. And so this was the low from last October, and I put the Fibonacci tool at the bottom of that low, extended it up to the most recent highs. And so from a Fibonacci analysis perspective, we would expect price to pull back either to the 38%, 50%, or 62% retracement levels, right? That's the Fibonacci analysis of this. So from a Fibonacci perspective, we're looking for price to get down here at about 480, right? It's 4,800 on the SPX. It's 480 on the SPY, which is the S&P 500 ETF. So 4,800, as you might recall, is also the top from January 2022. So that should provide quite a bit of support if price gets down there. So the weekly candle last week, right, we had a really big down week. It was down like 3%. At the beginning of the week, price opened at the top of the rectangle and closed at the bottom of the rectangle. And it found support at that 20-week moving average line. Okay. This week, price opened at the top of the rectangle. Now this is as of Thursday morning. So Thursday morning, where I was looking at it, that's where the pre-market price was right about 5,000, which is this line right here. So as of Wednesday night, price was at the top of the rectangle, right? It opened at the bottom of the rectangle, moved higher throughout the Monday, Tuesday, and Wednesday, closed Wednesday right here. Thursday morning, it's going to open down here. Okay, so it looks like if things continue, it's going to be a reversal week. Okay, we're going to see something like this, right? It will probably be green. As long as price stays above where it opened, it'll be green. But it'll be, an open here, came up to this high, this wick, and came back down. And if it closes there somewhere, this will be green, but it'll be a big reversal week. But still, most likely above that 20-week moving average line. So if you're following this on a weekly basis, you really want this 20-week moving average line to hold. Okay? Okay. And again, price can go, up, down, or sideways. But what we're really looking for is this line to hold, and if it doesn't, there's a lot of support at 4,800. Both 38% retracement level from a Fibonacci perspective, and back here because it's the top from January 2022. Okay. All right. That is all I got. If you guys want more kind of in-depth analysis, we do the newsletters every weekend for subscribers to the site. Definitely check that out at growmytsp.com. If you guys have questions, please post them in the comments, and we will absolutely get to them. We will be back in the podcast studio next weekend. Have a great week.